In this video, traders, we're going to look at selling the lower high. Some options, some strategies, some methods. Stay tuned. Hey guys, so lower high, pretty textbook stuff. We see this all the time as kind of, hey, this is a good bearish reversal pattern. Market makes a fresh high, comes lower, makes a second high, which isn't as high as the first high. And then that is a signal that the market's running out of steam and it's going to the downside. So why do people like this so much? So the theory behind it is this. If the price goes up to a level and comes back, that's the reference point now. That's the level where everybody agreed, or the majority of people agreed, that the price was not worth any more. So for whatever reason, it stopped exactly there. Buyers weren't willing to pay any more. Sellers were quite willing to sell it at that level. It turned the supply demand around, we push lower. Nothing revolutionary or exciting about that. And that's just really this section here, just to push up and pull down. Now, when we make a low at point A, that is then buyers saying, I still think this is good value here. We're not looking for a complete reversal here. This is good value. I'm going to buy it. It's going to push back up. But the key now is when we get to a high that doesn't take out the high, what's actually happening under the bonnet? So you think about it, what's happening is price goes up and up and up. This time sellers are saying, hey, I'm not going to wait for that high again. I think that I'm going to go in a little bit earlier because I think this is an opportunity. And buyers as well on the flip side are saying, I don't think it's that good value anymore. I'm not going to pay any more, and that causes supply-demand imbalance and causes the shift lower. And so the idea is at some point we're looking to get short and hoping that the market reverses lower and kind of undoes all this, and maybe it's a longer term reversal on a daily chart, maybe it's a kind of intraday reversal back to a mean like a VWAP or a moving average on an intraday chart. So what are our options? So many people like to go short at C. So what is point C? How do we define it? Point C is the low of the pullback, kind of extrapolate it out, and people are looking to go short on a break of that low. So it's a breakout trade really. It's a very binary event. It's like, hey, either breaks below that or it doesn't. Now the pros of that is you can literally put it in the market. If it's a daily chart, you can have a sell stop in there to get you short and you can forget about it. It can come down, you get filled, great. Now the disadvantage with this, and it's a very kind of easy trigger to pull, there's no doubt in it, either does break that level or it doesn't. So you're in or you're out. The problem you have with this is it's a little bit late. It can be a little bit late to the party. You know, it's come back down. You might have to sit through some fake outs as it comes back up. There's a little bit of, there's never any free lunch, and that's some of the things you give up for having such a clear-cut entry. Now, of course, short at B is your other option. Now, okay, that would be the very best option, of course. If we could just all pluck the high out of the market and go short, hey, why not we just pluck the high out there? Listen, this is a real world, guys. We're never going to be able to do that consistently. We might get it from time to time, of course we do. But how do we kind of measure that? Well, what we can do is we can look at maybe if we kind of push that over here, maybe this level is more of a trend line up. In which case, we've already got the broader picture of the high-low potentially happening. If that then breaks the trend line here, maybe we can short it, so perhaps we can get a little bit short here. Now listen, noise is probably going to ping us out more often than not, but the risk-reward ratio on that is quite high, and then by the time we get to C and it breaks through, we've already got plenty of cushion in the trade. We're not too bothered if it breaks through or not, because the trade's looking quite good. Okay, so that's one way we can do it. The other thing we can do is we can literally draw a trend line down here like this. So we can say, right, I'm going to get short, but I want to see this fake out a little bit, because very often it does. It goes through C, fakes out and rips back up, but it doesn't go back up all the way, kind of goes up and tags a trend line. Now you've got, again, an area to frame it. So you can initiate your short at that trend line. You can perhaps have your stop above high B, and you've got quite a nice frame on the trade. And then hopefully that's then when it rolls over. And if the trend line's looking nice, it will be just enough to kind of suck a few shorts in, stop them out, and then roll over again. So you're really playing gaming theory here and thinking, okay, well, what happens if people are all sucked in, they come out and this? So you're giving yourself a little bit more stricter criteria. The downside of that is, of course, is it very often it's not going to come back up and do that. It's just going to go through the floor and you may well miss that. The upside, of course, is that you are kind of selling into green, which I like. You're selling into that push up. You're not waiting for the lows. The other thing which I kind of didn't talk about is that you can spread your risk across all these strategies. So you can try and get a little scale in at B, so get a small position on at B, being prepared to be stopped out a few times because that's the entry that's kind of less likely to work. The expectancy of that is low, but the risk-reward ratio is high. Then as we go down, maybe you can sell a little bit into the break there. So now your average is okay. It's kind of midpoint here. And then as it pushes back up to that trend line, you can have the third batch. So you're in a situation where if it doesn't push up to the trend line, you've got two times the position. If it goes lower, fantastic. If that one stops you out initially, that's fine. If it comes back here and fakes out and pushes back up, then your stop can be at break even. So your risk is now a little bit more limited because your real initial risk only comes in from picking that point at B. And if you're only a third position size, it's not the end of the world. As it comes lower, if you're adding at C, you're really never going to lose any money because your average entry, depending on how big and broad this pattern is, but your average is going to be the midpoint between B and C, obviously, so you could bring your stop down and protect your gains that way. So you've got a few options here. It's not a bad trade. It's a good setup sometimes. But for me, I don't like so much chasing stuff unless, of course, it's really picked up momentum. If for some reason it's literally just run through there, you're seeing solid red candles, you're seeing good volume, then maybe that's another reason to go, right, well, it's going to probably break through that low. Let's get short on it and expect it. And then that becomes a little bit more of a momentum play as well in the kind of broader context of a reversal play with a lower high. All right, guys, that's setting the lower high. Take care. Bye-bye.